By now, you've probably heard that there have been a number of banks collapse in the United States that all started with Silicon Valley Bank. So in this video, we're going to outline exactly who they are, how on earth it happened, what has happened since, what the government has stepped in and done, and what as investors we need to know and should be looking to action. Hi there, I'm Jarrad Brown, Australian expat financial planner here in Singapore, making these videos and content to help Australian expats make smarter, more informed decisions with their money. So let's dive right in. First and foremost, Silicon Valley Bank, the 18th largest bank in the United States, and probably a bank that you've never heard of. Now, there is a reason you've probably never heard of them, unless you are a tech startup in Silicon Valley or in the United States, then you've probably never heard of them and you would probably never have done business with them. They were essentially set up, they grew rapidly when money was effectively free at the beginning of COVID, and they largely did business with a lot of the venture capital backed startups, particularly in the tech sector in the United States, hence being based in, or being named rather, Silicon Valley Bank. Now, the deposits with this bank grew from around $50 billion to over $209 billion by the end of 2022. So they grew rapidly. Prior to that, they were rather small, particularly relative to a number of other banks, and then grew very quickly as a lot of these tech startups were kicking off and accessing very, very cheap capital in the United States. Now, what actually led to their collapse? Well, as they were getting all of these new funds, new deposits with the bank, they needed to put this money somewhere. So what they decided to do, in their view, a sensible, low-risk move, was to take this capital, take these deposits, and invest that money in US Treasuries and mortgage-backed securities. Now, you might recall mortgage-backed securities being mentioned in the last GFC, not necessarily a connection to this one, but just interesting that the same name appears yet again. And what happened was these relatively safe investments proved to be exactly the opposite when the Federal Reserve started to rapidly increase interest rates in 2022. The price or the value of these products tends to drop as interest rates are moving up. So what happened was the Silicon Valley Bank released their annual balance sheet and highlighted the fact that their mortgage-backed securities, their treasuries, were actually valued at around $17.5 billion below what they'd actually paid for them. Not good news. Now, there are many banks around the world, not necessarily the bigger names, but many smaller banks particularly, with unrealised losses sitting on their balance sheet. The issue for Silicon Valley Bank was they grew so quickly and had to invest this money so quickly that they didn't actually necessarily have the same safeguards in place as other banks. Now, at the same time, or very, very close to releasing this annual balance sheet, the bank decided that they would try and raise some money by selling stock or selling whatever they could. So on the 8th of March, the CEO came out and announced that they would be selling securities, but don't worry, you don't need to panic, nothing to see here. Now, being a Silicon Valley bank, operating with a lot of these venture capital funds, the news quickly spread that this bank might be in trouble. So Peter Thiel, see a big name in the VC world, told all of his clients, all funds, to withdraw their money immediately from SVB. This is where the phrase bank run comes in. People want to access their money quickly, they're worried that the bank won't be there next week if they need to raise capital. Therefore, they all withdrew their money very, very quickly, and this was obviously a big problem for the bank. Now, on the back of all of this news, what we've also seen is that the stock market has sold off, particularly the tech sector and the banking sector, on the back of this news. We saw names like JP Morgan, like Schwab, all off between 5 and 15%, even though the risk of contagion or the same events transpiring are next to nothing. So, in my opinion, and it is just my opinion, it looks to be a massive overreaction given what has happened for one bank that rapidly grew very quickly. Now, what have the regulators done and what has the government done on the back of this? Well, First and foremost, we've seen President Biden come out and announce that all account holders, so the venture capital funds, the tech companies, would be refunded. So any money that they could no longer withdraw, they would be repaid back that amount in full, and that would apply to each of the 3 banks that have also suffered the same fate. So we've seen Signature Bank, Silvergate and Silicon Valley Bank all basically tread down the same path, same sort of events have transpired. So good news if you're an account holder. However, if you own the shares, you get diddly squat. Too bad, an expensive lesson. You probably should have been paying more attention in the eyes of what the government has come out and said. So what does this mean for shareholders? What does it mean for investors? What can we take away from all of this? And should we be actually worried about our own bank accounts? Should we be withdrawing cash? Is this the next GFC? Now look, in my opinion, it is nothing like the GFC that we saw in the past. It will very likely give the Federal Reserve and other central banks around the world a bit of a time to reflect and perhaps pause in terms of future rate increases. It does highlight the need to review the balance sheet, review the reports, or have your financial planner do exactly that of the shares that you are holding. It is very unlikely that your Commonwealth Bank shares or DBS Bank shares are going to be releasing statements that look anything like Silicon Valley Bank. But if you want to be certain, a good time to simply review your investments and make sure that there are no nasty surprises or unnecessary risks there. But a few other things we can take away. One, obviously the importance of diversification. If you had all of your money in these VC style banks, yes, the shares went from around $18, $20 back in 2009 to around $715 odd at their peak. And now they're back at around 100 and the company is gradually going to be sold in all likelihood. So certainly important to be diversified, but also important to review your investments on a regular basis and sell down any of those that are starting to represent too large a portion of your balance sheet. Because $18 to $700 is wonderful, but $700 to $100, not so great. And that could have represented a large chunk of your investment portfolio. So certainly important to review a couple of things there. Make sure that you are reviewing your investments regularly, but also take advantage of opportunities that are just like this. Whenever we see a bank run, there is always going to be panic, and we've seen this in big names in the bank sector, big names in the tech sector, that are very likely not going to be impacted at all. We've got people at local bank branches trying to withdraw money, which in my opinion is just ridiculous. But whenever there is this sort of irrational thinking and irrational behaviour, there are no doubt opportunities in the market. So I hope that sheds a bit of light on what's happened with SVB. We'll certainly be watching this space very closely. There'll be some interesting events that transpire over the coming days and weeks, and we'll certainly keep you updated. But if you have any questions at all, do drop me a note. Please remember to like the video, subscribe to my channel, that would be much appreciated. Make sure the little bell is on so that you get alerts on our future videos. But I really appreciate you tuning in, and see you next time.